Welcome to Excel Labs Video 5 Financial Accounting. We're going to look at, in this demonstration, at creating a balance sheet and a profit and loss statement for the end of January 2012. We're basing this on an opening balance sheet, which was the previous month's closing balance sheet, which is right on the first sheet right here. See fixed assets, current assets, the capital, short-term liabilities. In the second sheet, we see a range of T accounts. Make this a bit smaller so you can see all of them. On the left-hand side here, we have license, vehicle, fittings, accounts receivable, cash in hand, cash in bank account, and inventories. These are the asset accounts. Already been prepared for you. On this side, we see the capital accounts, share capital, retained profits, accounts payable, and the long-term loan. And then we have expense accounts, sales account, cost of goods sold, as well as profit and loss account, which will be particularly important when we do our transactions, when we record them. On the last sheet, we see the profit and loss account, end of January 2012, as well as the balance sheet, which we're going to fill based on, as I said earlier, the opening balance sheets and our transactions. Well, let's start off with finishing the balance sheet, or the opening balance sheet. If the total value of fixed assets is not calculated yet, it has not been calculated yet, so we trigger a function using an equal sign, type sum, opening brackets. Now make sure to select those three components, license, vehicle, and fittings. Close the bracket and press enter. There's a quicker way of calculating sums in Excel. You just select the cell in which you want the sum to be calculated, and then you look on the Home tab, Editing Group, AutoSum, and just click on AutoSum. Now Excel suggests which cells should be added up. So before you press enter, verify, check if this is the actual values you want to have calculated, want to have added up. In this case they are, so press enter. And so on this side can just add up the total value of fixed assets plus the total value of current assets in order to get to the total value of assets, £45,400. Scroll a bit down here. Let's add up, or let's calculate the value of the capital side. And now we have to really be very, very careful. The share capital is an unknown value. We don't know that value yet, but we have a way of finding out what the value might be. We know that both sides, the total value of assets has to equal the total value of capital and liabilities. Both have to be the same because the accounts need to be balanced. Therefore, we can argue that, especially since we have no other positions in here, just the share capital is missing, that the share capital must be the difference between the total value of assets, which is equal to the total value of capital and liabilities, minus the retained profit for 2011 minus accounts payable. So let's just apply that. Let's trigger the formula. Select the total value of assets minus the retained profit for 2011 minus the accounts payable, and press enter. Excel tells us that the share capital therefore must be £40,000. Let's add them up and use the auto sum. Check if this is okay. It is. Press enter. The total liabilities, that sum is quite simple because there's only one line item in there. Use auto sum again. And then we can add up the positions, total capital plus total liabilities. And of course, not unsurprisingly, both are the same. Very good. So this was the first step. We were finishing of the opening balance sheet. And now we need to open the T accounts. We need to provide the opening values, the opening balances for the T accounts. So select the T accounts sheet. Let's start with the license. You see that in the license, on the debit side, there's already one position opened. Just the value is missing. So this is the value 1st of January 2012. Balance, opening balance, and this would be the value from the closing balance from the previous month. Therefore, all we do is we refer to that cell on the previous sheet. How do we do that? We type in an equal sign. Don't press anything else yet. Don't enter anything else yet. Just directly go to the previous sheet, balance sheet for 31st of December 2011. Select. Now you see that Excel provides you with a reference to that sheet. Now we have to tell Excel which cell on that sheet it should take the value from. The license value, since it's the license account, click on the cell. This moving frame indicates that this has been selected now for a formula. Press enter and you can see that the value has been taken directly from the previous year's balance sheet. Let's do the same thing with the vehicle. We're opening this with an equal sign. Select previous year's sheet. Click cell B5, in which the value is stated. Press enter, 3,500. Fittings, equal sign, fittings 2,850. Press enter, and there's the value. Accounts receivable is also an asset account. It's right here, 18,050, directly as an opening balance. And you see how this is going, so we can move a bit quicker. The cash in hand refers to the very same 1,000. The balance for cash in bank is 5,000. We don't have any inventories yet. We will have inventories during our transactions. If you would create this from scratch, you would later need to create a completely new account. So this would have these accounts sorted. Let's move over to the capital accounts. Well, with the capital accounts, since they are on the opposite side of a balance sheet, they need to have an opening balance on the credit side, as opposed to, as we just saw, the debit side for asset accounts. The share capital, we just calculated with 40,000. Let's refer to it and use this as an opening balance. The retained profit for 2011 was 3,550. know that when this is too quick for you, you can always pause this video and rewind in order to really diligently follow. The accounts payable opening balance also on the credit side, so careful, this is a capital account, a liability. In this case, account payable 1,850. There you go. The other accounts will become important to us, so we will not bother with them right away. So, if we have come that far, well done. We have now just opened our accounts. We are ready for our first transaction. So now, in particular, have your sheets available and look at the transactions at hand. Now, the first transaction is a purchase of a van for £2,000. 10% was paid in cash, the rest was taken on credit and will be due in 6 months. Now, how do we record this? How do we record this first transaction? Well, it's a vehicle and we have purchased a new vehicle. So we're looking for the vehicle account, which increases our asset base. Sure to type in the right transaction date. Now we purchase a new vehicle, and in the description indicates the opposing account which is to be booked. So in this case we are debiting the vehicle account and we are crediting 2 different accounts, because 10%, as it says, will be paid in cash. So the cash in hand account is directly affected by this. And the other account will be, because we are not paying it yet, accounts payable. So let's add those 2 accounts, accounts payable, and the other account would be, let's type it in capital letters, cash in hand. The value is 2,000, and don't forget, there needs to be an opposing booking, opposing record. So if we are debiting one account, we need to credit another, and we've just determined which ones they are, accounts payable and cash in hand. So let's look for the accounts payable, which is a liability account right over here. And record this 2nd of January 2012. And the opposing account in this case is the vehicle account. Now, as a quick calculation, the purchase of the van was 2,000. 10% was paid in cash. 10% of £2,000 is £200, which leaves us with £1,800, which have still to be paid. £1,800. So again, £2,000 right over here. £2,000 van was purchased. 10% will be paid in cash. It's on the credit side. Which are £200. Because we're paying in cash. And the remaining 1,800 on the credit side of the accounts payable. So well done. That was the first transaction. The second transaction took place on the 3rd of January 2012, and our debtors repaid £10,000 into a bank account. So let's first identify which accounts are involved in this transaction. One account would be the accounts receivable, because the debtors are those who owe us money for previously delivered services or products. They have not paid yet, and this is being recorded in the accounts receivable right here. If our debtors now pay, our accounts receivable, the value on that will go down because our debtors in total owe us less than they owed us before. So this account would be credited. Which account would be debited? Since we are going to get £10,000 into our bank account, we need to look at the cash in the bank account, and this increases. So let's record just that. 2nd of January 2012. The opposing bank account are the accounts receivable. We receive 10,000. And on the other side, there are the accounts receivable, which are decreasing in value. Their balance are decreasing. I'll explain in a minute what that means. So this is cash in bank account, is the opposing account, 10,000. Now if we were to calculate our balance right now, so after the end of the second day in January, 2nd of January, we would find that we have opened with 18,050, our debtors have paid 10,000, so in total our debtors would only owe us 8,050 after that. So well done, this was our second transaction. Let's look at the third transaction. The third transaction took place on the 9th of January 2012. It says that new stock was bought for £10,000, with half being paid from bank account and the remaining is due in 2 months. So let's again consider which accounts are involved. When new stock is being bought, that means that our inventory is increasing. Now we need the inventories T account, which has not have any opening balance per se, and this is debited. When an asset account, when an asset is increased, the debit side increases at the same time. So this was on the 9th of January 2012. And let's consider the opposing accounts. There are obviously two involved. One is the bank account, from which we are going to pay this half, so 5,000. And the other 5,000 are being recorded in the accounts payable. So let's do that. Inventories, cash in bank account, as well as accounts payable, because we are going to owe half of this. The inventory is increased by 10,000, that's the value of the stock we're purchasing. And the opposing accounts, the first one is the cash in bank accounts, when we are paying something, and this would decrease the assets, in this case cash in bank accounts, therefore this needs to be credited. In this case now, the opposing account is the inventories with 5,000. We're not quite done yet. The other one, let's make this better visible, it's a bit hidden here. The other account would be the accounts payable, and these are on the liability side. Was a bit too far. Click back. Let's look for the accounts payable. In this case, we are owing more now, and if a capital or liability account increases, that means that the credit side needs to increase. Inventories 5,000. You see that the fonts are not quite in sync, so we just make sure that they are. A bit too large. If this happens, don't worry, this is easily fixed. And there you go, we have recorded this third transaction. The fourth transaction took place on the 10th of January. An invoice of 1,800 for business rates has been received and paid in full. So we are being charged 1,800 for business rates. Now, a business rates would involve an expense account. There might be an expense account actually, which could be called business rates. In our case, we have one account called business rates. So we need to record this in the expenses when expenses increase. On the debit side, now we need to consider where the opposite, or what the opposite account is. The opposite account, if we pay it in full, in this case we're assuming that we're paying this bill from our bank account and not in cash. The information is not quite clear on that. We assume it's the cash in bank accounts, where we're taking the money from. And here it would actually make sense to, especially in the expenses account, to state clearly what was behind it, which would be the rates. So this would be an expense of 1,800. The cash in bank accounts need to be credited, which works out quite well, because if an asset account is credited, this means that the balance or the value decreases. Make sure to name the expenses account as the opposing accounts and add rates, 1,800. There you go, we're halfway through, 4 more transactions. The fifth transaction takes place on the 17th of January. The bill for gas and electricity has been received of £870. So let's consider which accounts are involved. That is an expense, quite clearly. So we need to debit the expense account, 17th of January 2012. Now, if the bill has been received, we have not paid it yet. Therefore, this constitutes a liability, and we have such an account with the accounts payable. $1,800. Almost 870. There you go. It's better. And the other side, accounts payable. See, so it's always good to double check the numbers. So accounts payable increases 17th 2012. We need to realign the formats, the font size. Let's finish this first. Expenses, utility, 870. Let's make sure that this whole account is now size 11. And let's quickly jump back, because here we have not determined exactly what this is constituting. So let's go back there. Utility. There you go. So it's always good to double check, and in Excel it's no problem to going back and modifying any data we have. Right. So that was for the 5th transaction. Transaction number 6 took place on the 20th of January, which was a bank loan which was received for £5,000. So Paul Smith and James Jones have received these £5,000. So which accounts are involved? Well, if it's a bank loan, it's very likely that we got this cash not in hand, but in the bank account. So we got a loan, which means that our assets in the cash in bank account increases. So the 20th of January 2012. Now what is the opposing account? Let's check quickly. There is a capital account which we have not used yet, the long-term loan. This would be the opposing account. Long-term loan of £5,000. Of course, we need to pay this back eventually. Therefore, the 20th of January 2012, cash in bank account, £5,000. There you go. There you go, we have the next transaction already covered. That's very good. Let's look at the 7th transaction. So 2 more to go. Wages of 3,000 have been calculated and paid to full-time staff, which took place on the 22nd of January 2012. So let's again consider a wage is an expense. So we need to consider the expense account, so 22nd of January 2012. Now what would be the opposing accounts? Well, if they have been paid in full, or paid to full-time staff, that means that one of the 2 cash accounts is involved, and it is very likely that we are paying this from the bank account and not in cash, because usually we'll get a pay slip and there would be a transaction from the bank account of the corporation to the bank accounts of the employees. So it makes sense that this cash in bank account is involved. Let's make sure to label it that the way these are the wages. 3,000. Let's move over to the cash in the bank account. Since we're paying, this decreases our bank account on the 22nd. Expenses again. This time the wages, £3,000. Very good, that was the 7th transaction. Let's look at the last transaction before we can close the accounts. The 8th transaction takes place on the 30th of January. Sales of 20,000 were made. This was paid in full by check. The value of the stock that was sold amounted to 8,000. The first, we have sold something. In the sales account, this is being recorded on the credit side. We are crediting this account of 20,000. Where do those 20,000 go? What's the opposing account? The opposing account, if these have been paid in full by check, that means that the cash in bank accounts is very likely to be the benefactor of this transaction. So cash in bank account, 20,000. Let's move over to the cash in bank account, 30th of January 2012. Sales, 20,000. But there's actually two transactions in there. The value of the stock that was sold amounted to 8,000. Now that means that our inventories decreased. On the 30th of January 2012, the inventories increased by 8,000. But what is the opposing account? That would be the cost of goods sold. Yeah? Remember the matching principle? If you're unsure what the matching principle is, please look it up. So cost of goods sold 8,000. We have an account which is called like this. So if this was credited, we will debit this account 30th of January 2012. Inventories 8,000. There you go. That was transaction number 8. Now if you want to rewind at this point, please pause and rewind the video. And we're going to continue in the second part, in the second video, by closing the T accounts and closing the profit and loss statement and the balance sheet.